All right, welcome back to our third episode on China's stock market, where we cover the last week in mainland and Hong Kong markets. The big news items, give you my opinion on what's happening in the world's second largest economy. Not much this week in terms of market movements because we've had Lunar New Year. So happy Chinese New Year to everybody out there. Happy Lunar New Year. Mainland markets have been closed for a week. Hong Kong markets open for a couple of days, but we'll discuss that when we get through the market wrap. This is our third episodes. Doing it well, keeping it consistent, and I'm hoping that you are enjoying it. And hopefully, we get a lot more people watching these every week. I do plan to expand the content, interviews, some direct pieces on specific areas of the Chinese market. But let's just wrap up what's gone on for the week, because there's always news happening within China, even when the markets are not open. Before we do that, let's do our disclaimer. This is not personal advice. It doesn't constitute a recommendation to purchase or sell securities. It's not intended to be advice, although I try to keep everything up to date and as factual as possible. Sometimes it's my opinion, sometimes it's incorrect, sometimes it's not up to date. And of course, the opinions are my own personal opinion. All right, with that out of the way, let's run through what we're going to talk about. We're going to do market wrap. We're going to dig into Alibaba earnings. Now, I promised that last week. I didn't get to it, so I'm going to do it this week. I'm also going to look at Yum China, which had some earnings call. I think there were a couple of earnings call. SMIC, which I was going to cover, which was their semiconductor. I do have a lot of opinions about that company. I think that'll come to play as we go along through this channel. But I'll run through Yum Brands. I'll talk about steps to stabilize the market. We hear a lot about, the volatility, the lack of buyers, what are regulators, what are institutions, what are enterprises, what are the regulators trying to do within China to stabilize the market. I'll talk about share buybacks, which came up in Alibaba and Yum China Brands' earnings, but is a phenomenon or a feature now of Chinese stocks. I'm going to talk about the news around the MSCI index, the removal of 66 Chinese stocks, and the weighting down of China's emerging markets, or how much it makes up of the emerging markets MSCI index. The headlines look bad, but if we look under the surface, they're not as bad as they make it out to be. And then we'll look at holiday numbers. So we'll just see what's happening in terms of the biggest yearly migration that occurs of human beings in the world around Chinese New Year. Urbanized citizens going back to the country, to the regional areas to visit their family and celebrate Chinese New Year, and in this case, the Lunar New Year. So we'll cover all that. I'll give you my opinions. We'll go from there. Again, if you haven't subscribed, hit the subscribe button. It does help. Hit the bell notification, and if you can leave a comment, just with any questions, anything you want me to cover, share it with your friends. Not many people covering China's financial stock markets like we cover it here. So I'm hoping that there is an appetite for it and we get more interest. And I'm hoping that I'm delivering good content that you're enjoying. All right, let's get into it. It's all about performance. Only covered the Hang Seng because Shenzhen, the Shanghai Composite pretty much closed for the whole week. This is the last 5 trading days, minus 2.07. We did see Tuesdays open on the back of bad CPI numbers out of the US, which didn't get off to a good start, but fairly stabilized. We haven't seen massive movements down. Take this with a grain of salt, considering we've been closed for so long. It probably will incorporate a couple of days before we went to the Lunar New Year. But regardless, the last 5 trading days on the Hang Seng has been minus 2.07%. All right, let's get into some earnings now, and let's start with Alibaba. All right, let's take a look at Alibaba earnings. Now, we said we were going to do this last week. We didn't get to it. I did promise I was going to do it. So for the 10 viewers that viewed last week's show, let's talk about Alibaba earnings. Kind of a little bit too late, but I think it was very important to cover because this is a bellwether of Chinese market. If you probably look at foreign investors, if we talked about probably most owned Chinese stocks, I think this one would be one of them. Tencent, Pinduoduo, definitely, considering the run it's had. This was China's largest company for a long time. It was on track to be China's first $1 trillion company. I can't remember if it got there or not, but it got awfully close if it didn't. And recently it's fallen from that. It's been overtaken by Pinduoduo. as its largest company and also its darling tech stock. And it's had everything but the kitchen sink thrown at this thing. It's been through a lot of pressure. The proposed breakup recently, the overarching regulation, the fine, the scuttling of the Ant Financial IPO, which seems so far away now, so long time ago. Jack Ma in, out, where is he? A lot this company has gone through. It reported its fiscal quarter three was 2.03 billion. Earnings per share was 80 cents. Adjusted earnings per share was 2.67, missing expectations of 2.73. Quarter three revenue, 36.67 billion. That was forecast to be 37.2. It kind of flagged slower growth for 2024. It talked about it being a investment year, and therefore, profit was going to be weaker. Its revenue increase was 5.1% year on year. Not bad, but not what you want out of a growth tech stock. You want those double-digit growth. So the market did not like that. It's had a lot of headwinds. It's faced a lot of pressure and severe competition locally from Douyin and PDD, which have kind of changed the e-commerce landscape by selling lower costs and discount items year on, year round. Also that group buying, which I think, its local operations, Taobao and Tmall, didn't really adjust to. Some of the key areas, was AliExpress. You can see that at the bottom, rose 60% year over year. They did talk about its business restructuring. So if you don't know, there's a proposed restructure of Alibaba's 6 major businesses. If you don't know what they are, that's their cloud intelligence group, which is their cloud computing, which has about 34% of China's market share, a massive market, and looking to expand overseas, which we often forget about Chinese companies. We talk about where's the growth going to be. Well, it's the expansion into overseas markets. We're talking about some of the largest companies in the world here. Taobao Tmall, which is their local e-commerce, which again is facing a lot of pressure there, but makes up of 2/3 of Alibaba's revenue, so very, very important. Then their global digital commerce group, so we're talking about their 6 kind of units that they're going to split into. Global digital commerce is basically Lazada and AliExpress, and you can see growth in those markets. They've become very popular in areas such as Russia, Latin America, and parts of Europe, particularly Eastern Europe. The local services group, which is pretty much their food delivery app, LME, as well as AMAP, which is a mapping app. Canyano Smart Logistics, it's a logistic company which they formed in 2013. And then their digital media and entertainment group, which is things like Youku and Alibaba Pictures, which has done pretty well lately, Alibaba Pictures. They talked about our top priority, and this is from the CEO, is to reignite growth of our core businesses, e-commerce and cloud computing. So really focusing on getting back into their domestic market. But they have been the victim of a few things. You've got a slowing Chinese economy, a slowing consumer, and you talk about the rise of PDD, but PDD hasn't been hit with the regulation that China has hit. The external pressures, the fines, the pressure, the movement in, the breaking up of the company. So all in all, for a company that's been hit with everything, it's kind of surviving these 12 rounds. I think it's cheap when you look at it compared to its valuations, when you look at its tentacles overseas, when you look at its movement to expansion, when you look at how much of it's embedded into the Chinese consumer, which I think will rebound at some point. I like the valuations of Alibaba. I own it personally. I have been buying on the way down. It hasn't been a great trade for quite a long time. And they also talked about increasing their share buybacks. Now, I will talk about particularly around share buybacks and how this is a support mechanism for the Chinese market in general, but they also announced that. Keen to see where this company goes. I really like their cloud computing division. Who knows what's going to happen with these 6 units? It kind of was, this is going to happen. Kind of feels like it might not happen anymore. And this is where the regulators got to step in and give some more clarity for Chinese investors, for investors in Chinese markets. What is going on? Give us some clarity so then we can adjust and move on. And that's one of the criticisms I think I've had. We talked about some of the notions about why China is uninvestable at this point in time, or why people believe it's uninvestable. And one of them was the stop-start nature of regulation within the economy and the regulators. They've got to come to the plan. Now, often we think of China as some monolith with, President Xi pulling all the levers and controls. It doesn't work like that. It's an army of bureaucrats. It's a very complex economy. It's a very different economy to the rest of the world. They don't want to be like the United States. But we need some assurity, and the regulator needs to give us some. So that was them. 5.1% revenue increase year on year. Did forecast a decrease in growth as they reinvest, and hopefully as a shareholder, this means we see a greater 25, 26 and 27 going forward. All right, let's look at some other earnings. Looked at Yum China earnings. They announced that during the week. If you don't know who Yum China is, they run the brands of KFC, Pizza Hut, as well as Taco Bell, Little Sheep, Huang Ji Huang, and Chauffeur within the Chinese economy. So let's look at some of these key numbers. Quarter 3 total revenues increased 2.91 billion, 9% year on year. Not bad for a consumer discretionary business. I think it's quite good. Revenue 11 billion, up 15% final year 2022 from financial year 2022. Net income up 827 million, up 87%. Profit margin, really good sign, up 7.5%, up from 4.6%, driven by higher revenue. And EPS was a massive beat, 1.99. These are US dollars, from US 1.05 in financial year 2022. Now, kind of two schools of thoughts here on what was a very, very good earnings report from Yum China. Well, is this an indication that the economy is weak because more Chinese consumers are going to cheaper brands? Hey, Pizza Hut ain't too bad. And dining at cheaper brands, and therefore that's a reflective of a weaker Chinese consumer? Or is it the other way around, in that the Chinese consumer is still going out and dining out? I think it's half-half. You got to remember, these are relatively newish brands to the Chinese economy. They are expanding in a lot of the lower tier cities, which haven't had a Pizza Hut, which haven't had a KFC, which haven't had a Taco Bell. So it's relatively new. So, there at least is a consumer there. They reach a third of China's population, which the CEO, Joey Watt, said. He actually said, currently serving just 1/3 of China's population. Our ambitious goal is to extend our reach to half the population by 2026. He continued, over half of our new stores are located in lower tier cities, strategically positioned to capture the demand from long-term consumption upgrades there. So back to my point, you could say it's actually a weak Chinese consumer because they're going to lower tier brands, or it's a strength for China. I think it's a combination of both, but let's look on the positive side here. This was a good earnings call from a Chinese company that's operating very well. They increased their share repurchases, and they declared a cash dividend of 13 cents per share. So this stock really pop on the back of that. I think that was up from 7 cents. So this actually represents, a pretty good dividend yield for investors in a company I think is well positioned to grow. Particularly as, like they said, they only serve a third of the China's population, which is what, 350, 400 million people. So that expansion, I think, will be fairly new concept for some Chinese cities. I think this is, a really good company. I don't own it, actually. I was thinking about buying some off the back of the report. I haven't done that as yet. If you look at it compared to some of their competitors in the market, such as Starbucks and McDonald's, they actually cited a weaker Chinese consumer and a reluctance from Chinese consumer to spend. And therefore, they've had to cut prices. Starbucks actually said they're not going to cut prices. They want to remain a premium brand in that coffee market within China, which is one of the largest markets in the world. But I think a good call from a good Chinese brand, or Yum China, which operates kind of American brands within China, and a bit of a good positive news out of China in terms of earnings. All right, let's take a look at this topic, which I thought it'd be good to cover in the Lunar New Year week when markets weren't open. Chinese mainland markets were pretty much closed for the whole week. We had a couple of operating days, as we covered earlier on with Hong Kong, about what is actually going on and how are the regulators and the central government and the PBOC and all the relevant army of people who are looking to grow the economy or run the economy, how are they looking to stabilize the market? This is obviously very important for them, because if they're Chinese consumer, if their stocks are going down in value, therefore they feel less confident about their economy and, more importantly and more specifically, their wealth, and therefore they're less inclined to spend. If they're less inclined to spend, GDP growth is slower. Firms don't invest in expansion. They don't employ new people. If they don't employ new people, those new people don't get wages or higher wages. Therefore, they don't spend as much, and you have that cyclical effect that runs through the economy. You combine that with the fact that the property market has slumped, down 25 to 30%. They're worried about properties getting built. It makes up a massive portion of Chinese wealth. It makes up a massive portion of Chinese GDP. You kind of got the double whammy. What are they doing to try to stabilize it? So this article was run through Bloomberg. There's a link there which was reprinted in fastball.com. I'll drop it in the notes section. I forgot to do that last week with the articles. I will do that going forward. But what are they doing? And there's a number of levers or mechanisms they're trying to pull out in order to stabilize this market, or put some type of floor in it to try to entice some buying domestically and then some foreign investments. I've said this, and I said this last week. I think the sole concentration of regulators, of the various associations, should be to stabilize the Chinese consumer or the Chinese domestic buyer of shares. Unlike the US, the steady hand is an institutional hand, kind of gives a steady market hand. In China, it's an army of retail traders. Mainland Chinese citizens who buy their Didis, who buy their Tencents, who buy their Alibabas, who buy their Pinduoduos and hold them. They have been leaving the market, along with foreign investors. They are that steady hand, and that steady hand has now gone. They need to shore up that hand. So what are they doing? Well, the first thing they're doing is state and national team buying, along with several sovereign wealth funds. So they're using their assets to go in there and buying. The national team are fund managers, money managers within China, who are using their funds to go on there and buy things like Chinese ETFs, because if they buy Chinese ETFs, the underlying ETF then needs to buy the Chinese stocks. There were reports from Goldman Sachs that it was up to 9.7 billion in the last month of January. That's support for the market. You have sovereign wealth funds, which usually go and buy overseas assets for the sovereign wealth funds on behalf of the government. A major one, Central Huijin Investment, which holds massive stakes in financial institutions, said it will be buying more Chinese assets, particularly exchange-traded funds. Trying to get that buying up, trying to stabilize the market. The assumption is if they buy it, they're going to be long-term holders, and therefore, they're absorbing some of that selling pressure, releasing some of that selling pressure so that more buyers can push up the price. You have the regulators stepping in. So you have short selling restrictions. We saw that in early January. We saw that again in February. Basically, some banning on some type of short sellings, on how you can short selling, how you can declare it, how long you can hold or short sell for, in order to relieve some of that selling pressure. If you don't know what short selling is, that's basically betting on the stock or the asset to go down. In order to do that, you need to borrow shares and then sell them on the market. You borrow off someone, you sell it on the market, you create selling pressure. The other one we saw in January, late January, early February, was a report that the Chinese Securities Regulatory Commission went around to listed companies in 20 provinces and municipalities in China, saying, checking in. How's things going? What do you need? What do you need from us? What's the issue? How can we help? And that certainly is a good sign, because they've been, responsible for a lot of the trouble that we've seen. We talked about last week, what are some of the reasons why people are saying, or the notion is, China is uninvestable. And one of those is because of regulatory unknown. When are they going to step in? When are they going to break it down? We talked about gaming. We talked about education. We talked about, Alibaba and Alipay, etc., that have come in. That is a massive issue. It's good to see the regulators going out, checking in with their companies. The other one was support for their housing market, which has been a major, major hole in the Chinese economy. 25 to 30% of Chinese GDP from the housing market. A lot of wealth is held in housing. Remember, that's been a big wealth gainer for the Chinese consumer, which has led to more Chinese spending, which has, created some of these national champions that we talk about. We've talked about, real estate easing, so they've lowered down payments, particularly in areas such as Beijing, Shanghai, and Shenzhen. So, you needed 10% as a down payment. It's now 5%. They're not the figures, but I'm giving you an example of what I mean. That's been done since November. You've had aid for developers. We talked about the whitelist last week. The Ministry for Housing and Urban Rural Development going around and funding projects that are a little bit under pressure. You saw a boosting in lending for real estate and for developers to get them going. So they're doing everything they can to support housing infrastructure. Remember, a lot of what housing has occurred in housing in China was because of the government, who increased the capital ratios for developers. They said, in order to develop a market, you need X amount. Now you need X plus X amount. And that was kind of the first domino effect in the property market tumbling. So there's that. You've also seen some monetary stimulus. So you've seen the reserve requirement ratio for banks, how much they have to hold before they lend, decrease. Not as much as the market wanted, I will say. Not as much as the market wanted, but certainly they've done that. And we saw the biggest cut since 2021 recently in late January, on January 24. So they're trying to increase long-term liquidity into the market to create more lending, to boost the economy, and therefore boost its market and its share market. You also have some moves in regulators. So you saw just last week, which we covered very briefly, they changed the China Securities Regulation Commission head, the butcher broker, some call him, I forget his name. You saw reports of Z meeting with the regulators. I mean, they really want to get this into play. They want to support this market now. I feel there's been some missteps, and I feel they are feeling it's gone too far. And if they don't catch this falling knife, it'll continue and it'll have more ripple effects into the economy. Remember, your wealth is going down, you're less inclined to spend. You're less inclined to spend. We talk about that cyclical effect within China. And the regulators are doing everything they can to do that through some of the things that you can see in front of you on that chart or on that diagram. The other big thing, which I think will produce some type of support mechanism, and we talked about it when we discussed Alibaba's earnings call and Yum China Brand's earnings call, was an increase in buybacks. This is a chart or a graph or a table or whatever you want to call it. It's a chart from Bloomberg. Now, Bloomberg has been tracking this since Jan 2021, and you will see it's the biggest value of share buybacks by Chinese A-share companies each month. So it's a record. So what is happening here is Chinese firms are using their cash holdings or their profits to, yes, invest in growth, to possibly pay a dividend, but also to buy their shares on the market. So they have to go onto the market, sit on the bid, and buy up their shares. A couple of reasons why companies do this. One is they feel their shares are very undervalued by the market. Therefore, they want to buy some of them in anticipation of selling them at some stage at a massive profit, okay, which they will use to fund further growth or pay dividends, etc. The second one is share price is declining too much. They've got some cash. They need to kind of stem that. Combination of both here, in my opinion. The third, which is kind of a feature of the Chinese economy and very unique, is I think they're getting pressure from Chinese regulators, from the Chinese Central Committee, from the China Committee to, hey, listen, we need to stem our market here. We've got some national buying, we've got some state buying, we've got the wealth funds coming in, we're trying to stem it with liquidity. However, this is another prong, another attack at stabilizing our market. Let's announce some share buybacks. And you can see the growth that has happened since 2023. Now, this is, all in all, a good thing for markets. If you have companies buying back their shares, one, they're providing a floor on the stock price, hopefully. And two, they're hopefully, providing a push upward because they're buying their shares up. So, we often criticize the regulators for where we are, and I think there is some due criticism to where we've gone. I understand some of the reason why they started with their regulation. They're tech companies. We're going to discuss this. I think I'll discuss this a little bit more as we go along. But when you talk about, okay, where's the action, and I have been critical of where the action is, there is some action. It's not working at the moment. It is not working. But I think you're starting to see some flaws in there. I think foreign investment will come back into China. Overseas fund managers like myself will see value and they will chase their tail if they feel they are underinvested. A lot of the EM flow, we're going to discuss this in the next slides, is flowing towards India and other areas because of this notion that China is uninvestable. I think that'll come. But I think the first point of call is stem your local market. Get Chinese citizens bullish about Chinese stocks again, like they were. Get that army of retail reinvested, because I think if they are reinvested, they are long-term buyers and long-term support mechanisms for the market. And then the foreign investment will come. And I think this is a really good point when you talk about, if you want to look for signs of bullishness in the Chinese market, then Chinese companies buying back their shares are usually a good sign. It certainly has been a good sign for US stocks and their US counterparts. And then again, valuations. Valuations are quite cheap. In what I believe are some of the greatest companies in the world still. Just underappreciated and have a massive public relations problem. All right, so let's have a look at the headline, and this was released on Wednesday, February 14 or Tuesday, February 13, depending where you are and when you looked at it. But the headline was MSCI cuts stocks from their indexes. So if you don't know who the MSCI is, it's the world's leading kind of aggregator. You can invest in these things, and they group together indexes or regions, etc. So the emerging markets region will group together China, India, Vietnam, Africa into an emerging market baskets, and then have underlying stocks from those countries. So you can see the Bloomberg article there. MSCI cuts a swath of Chinese stocks from its indices. The Wall Street Journal, MSCI drops 66 companies from China index, and that's the all China index that they cut from. So let's have a look at it on the surface, and then let's have a look at deeper at actually what happened and maybe some of the ramifications, or maybe some of the part of the scenario here is, and I wrote there more bad news, it's just further bad news for China in a PR campaign across the globe. But the headlines made it out worse than it possibly was. So firstly, what happened? So they removed 66 companies from the China index, which will have flow-on effects for removing them from other indexes, such as the MSCI and the all-world MSCI index. They took 66 off, but they also added 5, so a net of 61. Okay? Now, why is this bad? Well, if you remove them from the index, therefore you no longer hold them in the index, therefore you have to sell them down to reflect the weightings of your index, providing further selling pressure for China. It also, again, in notion of, hey, what's happening? Look, Chinese companies continuing to be removed from the index, also not a good look. Notable companies that were cut: Gemdale Corp, Greentown China, China Southern Airlines, I've flown them, and Ping An Healthcare and Technology Company. And then there were a couple from Hong Kong which were removed, which were Budweiser Brewing Company, New World Development, and a glass company. And the additions were Media Group, who I think is a great company, and Giant Biogen Holding Company were added to the index. Again, headline's not great. Let's dig a little bit deeper and see what's going on. So 66 companies were removed, 5 companies were added. Now, when we look at the EM index, which is the emerging markets index, which China is the biggest weighting to, they fell from 25.7 to 25.4, and that's kind of as a result of that 66 that have been removed from the All World China Index. Okay, so you kind of remove those and you've weighted that down into the emerging markets index. If you look at the All World Index, the US, so this is All World, when MSCI looks to put together an index for the whole world, 62% of that index is made up of US companies, and you can guess at what the major portion of those are. That's their US tech companies. We continue to hear this notion of, money's moving from China to India, The place, the center of emerging markets is now India. Fair enough, there has been some considerable movement. But when we look at it at a whole, India went from 17.9 to 18.2. If you read the headlines, it seemed like it was a lot bigger. And China went down from 25.7 to 25.4. If you look at the largest holdings of some of those stocks, so, that component of 66, when you look at the emerging market index, the largest component of that was 0.03% of the whole index. So that wasn't a massive sell down. But again, India went up. Now, we've got to remember, when you look at weighting, I think it's disproportionate a little bit. China's GDP is 4 times larger than India. 4 times. Not double, not 3, 4 times larger. It dwarfs it in terms of economic GDP. However, there's a clear movement away or a notion to move away, and this just adds further when people read the headline. But when we look into it deeper, it wasn't world ending. Okay, it wasn't world ending. In fact, the largest stock to be removed was China Soft International. I'm taking this from the guys at Crane Shares, which had a 0.03% weight in the MSCI Emerging Market Index. All right, but a piece of headline, maybe when an international investor or someone else looks at it, says, China's uninvestable. Not a massive weight down. And like I have said previously, I think eventually, I do believe that fund managers around the world will be chasing their under allocation in China at the moment in the long term. Because I think the prospects of the Chinese economy are very, very bright, despite all the news that you hear around them. The guys from Crane Shares also highlighted this, and I did see a few articles that at some point during the week, Amazon and Nvidia's market caps were larger than the market caps of the MSCI, China, India, and Taiwan, and either of them could buy 2 South Koreas. So the market caps of Amazon and Nvidia were bigger than China, India, and Taiwan combined. So I also heard this report, you talk about crowded trades. The 2 biggest crowded trades when they took a fund manager survey was long big tech, Microsoft, the Magnificent Seven, Microsoft, Amazon, Netflix, Google, Facebook, or Meta, Nvidia, I've forgotten one. Apple, how can I forget Apple? That was the largest or the biggest crowded trade, and on the other side, the biggest short crowded trade was China, which makes you think, eventually you look at shorts, You short, and eventually you got to buy back your shorts and you get that long pull. But again, piece of news, not so great on the headlines. But if we look at it underneath, it wasn't a massive move. So I thought that would be good to cover. And then lastly, before we finish up today, I just wanted to cover some of the travel numbers. These are taken from Crane Shares, who probably have the best Chinese stock information on the market, other than me, of course. So when we look at, it's really important to look at Chinese New Year data, vacation data, and travel data. So Chinese New Year vacation and travel data show strong trends within mainland China to Hong Kong, Macau, and overseas. So it's a sign that the consumer is actually got money and willing to spend, if they're willing to spend on tourism, which is a discretionary item. For 2024, the China Tourism Research Institute predicts a 22% increase in domestic tourism to RMB 6 trillion. That's a massive move as it starts to open up. And obviously you had the COVID lockdowns for quite a long time. Who will benefit from them? Maybe Meituan, Trip, some of the lifestyle companies there. International tourism, I'm certainly seeing this here in Sydney, Australia. We're seeing Chinese tourists come back. You see them around near the Harbour Bridge and the Opera House. I recently had my auntie here from France, took her to Bondi Beach, filled with tourists. And I think some of them were made up of Chinese tourists, which is starting to come back. I've certainly seen a lot more buses, etc. So international tourism is expected to increase by 38%, which is a sign that the consumer is strong. Well, stronger than we think. Reaching 105% and 81% of the 2019 levels for domestic and international tourism. This is obviously pre-pandemic. On the first day of the holiday, there were 195.24. This is the first day of the Lunar New Year holiday. 195.24 million passenger trips, marking a 26.7% increase year over year. So last year, which is showing that the urbanized citizens of China are getting on the train, getting on the plane, getting on the bus, and getting back or going for a holiday, and therefore consuming. And what are they consuming? They're consuming Chinese products, Chinese services, which may be an indication of an economic bounce back within the Chinese consumer, which is not the number one premise for an economic bounce back. It's still an export-driven economy, but certainly its consumer is a larger part of its economy going forward. So not all negative news when we look under the surface of some of the headlines and when we start to look at the travel numbers and the granular numbers within China. If you listen to other podcasts or shows or YouTubes or videos, you will see that it is all negative news. And I'm not saying it's all positive news out of China, but it definitely isn't all negative news out of the second largest economy in the world. Now, whether it's positive or negative, we're going to cover it on this channel. And we'll cover all the big headlines for next week. Once again, thanks a lot for tuning in. Hit that subscribe button. I appreciate it. And as always, good luck with your investing.